Hey everyone, welcome back to the channel. Today we're diving into an investment strategy that could change the game for you. I'm going to show you how you can borrow against your stock portfolio to secure a down payment or buy your next property outright with cash. Stay tuned. Imagine you found the perfect home in Seattle, or perhaps you're eyeing an investment property that's just too good to pass up. But there is just one catch: the down payment. It's a hurdle many face, as it can be either too high, but what if I told you that your stock portfolio could be your golden ticket? I've worked with hundreds of home buyers and investors, and a common trend among them is the desire to avoid capital gains taxes from selling their stocks. For example, take on a recent client of mine. They needed a $420,000 down payment for a $2.1 million property purchase. They also had close to $2 million of vested restricted stock units, also known as RSUs. An RSU is an employee-based form of compensation in the form of stocks. It'll have a vesting period, and if you decide to sell, you would have to pay taxes. For this client, selling meant taxes, and they weren't keen on that. They also weren't keen on the fact that selling their stocks would mean losing the future appreciation on the shares. They didn't want to go in that direction either. Their stocks are performing well, and they own two rental properties, and they didn't want to interrupt the rental cash flow, so they seem to be stuck. The solution? A pledged asset line of credit against their stock portfolio. According to Charles Schwab, a pledged asset line of credit is an uncommitted, non-purpose securities-based borrowing solution that allows individuals to leverage eligible assets in their investment portfolios as collaterals for a secured loan. It essentially lets you borrow from your non-retirement stocks as a way of financing, usually without having to liquidate your assets. So instead of borrowing from the bank, you borrow against your stocks already in your portfolio. Let's digress for a moment and take a look at the interest rate tables on Charles Schwab as of the day we recorded this video. This table represents the interest rates depending on your loan value. SOFR is the Secured Overnight Financing Rate, which is the interest rate investors charge banks in the process of lending money, collateralized by the bank's treasury securities. So if you're borrowing from $100,000 to $250,000, your APR will be at SOFR plus 4.65%. If you borrow from $500,000 all the way up to $1 million, it will be SOFR plus 2.9%, and if you borrow from $2.5 million or above, it will be SOFR plus 1.9%. So the higher your loan value, the lower the rate. Now back to the client. After consulting with our financial advisor, they secured the funds within 5 days using their stocks as collateral without selling a single share. Yes, there is risk. Debt always carries that. Though with only borrowing 50% of their portfolio value, the risk was mitigated. Now let's talk about another scenario: an investor at a crossroads. With not enough cash on hand, wanting to avoid capital gains tax, and not opting for a 1031 exchange, they too turn into a pledged asset line of credit against their stocks. So they purchased a 6-unit building outright with cash in Seattle for $1.4 million. The cash flow from the property is at 12% more than covering the cost of borrowing, which was under 2%. So they have a 10% arbitrage, which serves as a cushion in the event the cost of borrowing from the line of credit goes up, as it is a variable rate. This isn't long-term debt, it's a strategic short-term financing. And so when the interest rates on home loans start to go down and their property value starts to go up, they will refinance to pay the short-term loan against the stock while having the tenants pay for the refinance cost through the rent. Before you jump in, you need to understand how it works. This line of credit is versatile. You would use it for a new home, a renovation, a startup, though it wouldn't make a smart move to use the borrowed funds to finance other stuff like a vacation. That's a big no-no. Eligibility is broad, but collateral requirements are strict. You'll need a separate pledged account with assets enough to cover your loan value. And now for the pros and cons. On the upside, you avoid taxes on asset sales and enjoy competitive rates without setup fees or prepayment penalties. The rates can be as little as 2%. The con, remember, risks include potential liquidation of your securities if you default on the loan, the value of the stock falls sharply, and the forced sale will lead to tax consequences. There is no set term length. Demands for repayment can come at any time, so it's essential you stay vigilant. A quick disclaimer, I am not a financial advisor or a CPA. My advice, consult with the right professionals before making any decisions based on this information. A pledged asset line of credit can be a powerful tool under the right circumstances. If you're in need of quick cash and the cost of funds is low, this might be an avenue worth exploring. I hope you found this video insightful. If you have any questions, drop them in the comments below or reach out through the description in the links. Thanks for watching. I'll catch you in the next one.